DraftKings, a company, sports betting company that loses money, is making a $20 billion bet for Entain, a UK-based sports betting company. What the heck is going on here? If you'd like to learn more, continue listening. Welcome to the Red to Black podcast hosted by Werner and Mario, two Marine officers and businessmen. In today's series, Midnight Patrol, we're doing accounting deep dives. It might put you to sleep, or it might kill the business you're invested in or running. Mario, what are your thoughts on DraftKings?
Well, Werner, they're going after a massive acquisition. So they're elephant hunting. They're taking $20 billion of something, not free cash flow, but they're either debt or issuing shares to go after a British firm that's probably much better positioned to do gaming or gambling than a US-based gambling organization. Americans are a little bit tighter. They're not as aggressive. I mean, maybe football and stuff like that, but we're really not. The Brits love to bet on everything. So I understand what they're doing. The problem is they lose $843 million a year in operating income. So doing operations, mostly in the United States, they're losing money every year, almost $1 billion, $843 million a year they're losing. And they're going after a $20 billion acquisition. How are they going to accomplish that? So they're not drowning in free cash flow. They're not doing operations and creating free cash flow, and they're going to deploy a bunch of cash. They're going to get rid of, we got too much cash in our books, we're going to go after something and do a bolt-on acquisition. The acquisition, that doesn't bother me. It's the way they're going to go about doing it. They have to raise debt, or they have to issue a bunch of shares, or a combination of those two things in order to get the $20 billion. On the books right now, they have about $1.8 billion in cash and cash equivalents. So they have to 10x that plus a couple of billion to go make this acquisition. They're going to destroy shareholder equity, or they're going to transfer ownership to banks and bondholders. And that's destroying your ability to make money in this business. It's hurting the investor. If you're an investor in this business, you're getting hurt by them going after this acquisition. But they're going to say, the CEO, everyone's going to say, well, it's going to help us grow. Yeah, but your business sucks right now. Like it's a losing operation right now. And you're trying to go, this is how you're saving it. It's like we can't run our business effectively to create free cash flow. So we're going to have to go buy someone else's business. You shouldn't be in that business. Warner, what are your thoughts?
Yeah, so let's talk about that one point, Mario, that you were describing, which is the investor, because that's what this podcast is all about. How do you invest in highly profitable businesses? Well, you can see from the numbers, this business is not highly profitable. It's highly negative, right? So as an investor, the only way you are making money in this business is through pure speculation. You bought at this price and you hope to sell at this price. There are no guarantees that's going to happen. I mean, listen to some of Warren Buffett's conversations, which he's got on YouTube, where he talks to like business school students. There's one, I forget which school it was, but he tells them there's certain times, if you do your research in the past, where the markets, like from 1929, took 20 years, 30 years for it to get back from its lows back to its like just to the same height it was before. You go into a business that's based on appreciation, you willing to wait 20 or 30 years, it's a bad move. As we talked about in this podcast, there's plenty of other businesses you can invest in. There's plenty of other businesses that are paying a 2%. You at least make 2% of your money, like Oracle, Microsoft. I mean, if you want to go to the tobacco business right now, Atrium, or what, I forget the name of it. It's not Atrium, it's Altrium. I forget. I'll link the name below.
Altegra.
It might be Altegra. We're probably butchering the name, but the key here is that they got a 7 to 8% margin. They're trading at like a 7.5 multiple right now. Now, I get it. If you're not interested, we're not saying go into an industry that doesn't align with your values. But the point is, there's plenty of companies right now that make money, that will pay you a dividend to own them, and you'd be doing better off investing in a company that's paying a 2% than doing this pipe dream that you think you're going to make money because everyone's making money in Bitcoin, everyone's making money in the stock market. It's a fool's game. Appreciation is like the cherry on top of your investment. The meat of your investment is cash flow. You will either learn this the easy way or the hard way by losing a lot of money. Invest in a great business. This business right now, not in the future, we don't know in the future, but right now is not, my own advice, I wouldn't invest in it. Mario, any other thoughts?
Yeah, just for my two autistic nephews that actually like accounting, I'll just go to their statement of cash flows and you look at it's a miserable statement of cash flows. So number one is negative. Cash flows from used in operation activities is negative. You want positive cash flow from operating activities. Theirs is negative. So the first thing you look for in the statement of cash flows is positive cash flow from operations. DraftKings is negative. Next one you look for should be negative, and then the final one should be negative. So cash flows used in investing, meaning you're putting money to work. You're made money in the first line, cash flows from operating. The second line should be negative. You're putting it to work. Fortunately for DraftKings, they're investing. The problem is they didn't get that money from operating income. They got it from financing. The last one is positive, which you want negative. You want to be paying off debt. You want to be paying off. So you want positive cash from operations, negative cash flow from investing, meaning you're buying another business or buying assets, and you want negative cash flow from financing, which means you're paying off debt. They have $2.3 billion positive from financing. One of two things is happening, or a combination thereof. You're selling extra shares, diluting current shareholders' equity in the business, or you're raising debt, transferring ownership to the banks and to bondholders. It's a miserable business, folks. Stay away from DraftKings.
Yeah, Mario, 2 points to really hit home that you just described is there's only two ways a company can make business there's only two ways a business can make money. It's either from their operations, means they sell a good and a service and they make a positive profit on it, or they don't make any money there and they go into the debt and equity markets and they make money, or they borrow money, let's say, from other individuals, and they make it look like they're making money. This is the key differentiator in the accounting statements that, like Mario's talking about. You want to look for positive cash flow and negative financing, meaning a lot of money's coming in and they're reinvesting, meaning creating, as we talked about in other podcasts, they're creating more cash flow silos by reinvesting that money in a marketable security, in another business. They're reinvesting back in their company. They're buying back their shares to improve shareholder value. They're doing multiple things. That all starts with one thing. You're either making money off your operations or you're not, as Mario said. Those are the key things we look for. So I have another question for you, Mario. Well, then what's their game plan here? If they make no money, and a lot of companies are doing this nowadays, why would you purchase a $20 billion company? Are they going to make money in the future? What are your thoughts on that?
Yeah, so the game plan is I can't make money running my business operating income. So, and I don't want to go out of business. So I'm shooting for a lifeline. I'm throwing a Hail Mary. What they're doing right now, Warner, is they're throwing a Hail Mary. They're going to take on a tremendous amount of debt and they're going to issue a bunch of shares. They're going to take on as much debt as they can at a good rate. They're going to go after as much cheap debt as they can, and they're going to issue a ton of shares, and they're going to go after what they perceive to be a good acquisition in Europe, in a country and in a place where people like to gamble a lot more in the United States. And they're going to that's their Hail Mary. It could work. It could work. This could turn around. The likelihood is it doesn't. The likelihood is this company doesn't make money and a bunch of people get burned. And there's a bunch of people. The sad thing is, Warner, it's a publicly traded company. There's a bunch of people indirectly buying this business every month. They're actually investing into DraftKings every month, and they're thinking they're doing something smart. They're saying, well, I dollar cost average into the Russell 2000. I have a mutual fund, and I have it's in my 401k, and I buy it every month. I pay $300, $600, $1,000, $1,500 a month into the Russell 2000 or the Russell 5000 or whatever it is. They're actually buying DraftKings every month. They're investing in a horrible business. They are deferring their investment, their future finances to a mutual fund company, which is buying shares in these companies that are part of the Russell 2000, and it's a bad business. And they're thinking they're doing something smart every month. They're doing something horrible to destroy wealth every month, and they don't even know it. They don't even realize it. That's the tragedy of this whole situation with publicly traded companies that are garbage.
Well, here's an interesting fact. Some people may say, like, devil's advocate, oh, well, you guys don't know, they IPO, they're still going through the all the processes to go and make money. We had to go to the public markets. Look at Facebook. When they IPO, they made money from the get-go. Look for a company like Facebook. Look for a company. See, what Mario and I are pointing at is there's only going to be a few companies that IPO that make money, a handful. Invest in those. Don't invest in the pipe dreams, because here's the thing. Okay, they make a $20 billion asset, but right now they're showing us off of one unit, say one bet, they can't make money. So why are they going to make money off of another 20 billion worth of bets? That's kind of the play. Does Entain have a better system or better tech? Maybe it's a technology play. It could be a technology play. Do they have something or access to users which is going to suddenly rocket them into profitability? But now see, you're sitting on $20 billion of debt. Overcoming that debt, right? Now that's another obstacle you just put in front of yourself, and your profitability that isn't even there yet. It's just, there's just so many hurdles that they're putting in front of themselves. See, here's what we're pointing at. If you're a great company, like we talked about with that brand called Soho House, and you can make money, well, then make money from the get-go. If you can't make money, you're not a great company. You're not a great product. Make it from the get-go. And that's the point of this entrepreneurial world, this free market system. If you can't make money, you go out of business. But what we're supporting as a society as a whole is just keep letting these businesses go, because in our mind there's this assumption they're great businesses, but on the ground performance, they're not great businesses. The performance shows you they do not make money. This is why Mara and I are doing accounting deep dives, to show you guys, like, hey, this company doesn't make money. They could make money in the future, but right now they don't, and they don't pay you to own them, and they're not a highly profitable company. So in our opinion, what we would do is we would say, nope, not interested. We'll go find the company that makes money. Okay, thank you guys for listening to the video. Subscribe, like, and comment, and we look forward to connecting with you in the future. Sometimes I get